mind, in my head, this is where we all came from. The dreams we had, the love we shared, this is what we're waiting for. And in my mind, in my head, this is where we all came from. The dreams we had, the love we shared, this is what we're waiting for. In my mind, in my head, this is where we all come. In my mind, in my head, this is where we all come. In my mind, in my head, this is where we all came from. The dreams we had, the love we shared, this is what we're waiting for.
What is going on YouTube? It's Brendan from Market Makers. Hope everybody had a fantastic weekend. Guys, I have a fantastic video for you today. As per usual, we have the market pushing up a little bit here. Are we breaking out? We going to new all-time highs? We're going to cover all that in the video and go over our individual trade setups. Some of them, like First Solar. Man, how many of you took my First Solar trade at 217? Did you see where it hit? 170. Yes, 170, or the Tesla trade, which went all the way down into the 150s from 208. But guys, we have some. I want to talk about a topic. Let me set the table here. Let me back up, set the table. So everybody always asks me, who do you like to watch on YouTube? And I always reply the same to people. I prefer to watch economists. I don't watch people do TA. Part of that is because, when you're doing your own TA and you have a market view, I want to see what I'm missing in the macro view, if I'm missing anything at all. But watching people draw triangles or head and shoulders and stuff, a lot of it, I've been trading for over 20 years. So it's just very, it's very basic to me and I don't get anything out of it. But I do learn things from macro guys, these indicators that they follow and cycle indicators and traders of that fashion. So I do prefer to watch economists. But one of the key things I've noticed in YouTube is the propensity for people to tell people what they want to hear versus what reality is. And some of it, I don't think is necessarily a business decision. Some of it is, I just think people are very inexperienced, right? You have a lot of super young guys on YouTube, never traded in a bear market, don't understand macro market cycles, don't understand basic economics. But the problem is, the people that have been the most bullish, whether it's been in stocks or whether it's been in crypto especially, have wrecked and destroyed many, many people. These people that had the targets at 200K, Bitcoin, 250K, 500K. There's a big YouTuber that was predicting 1 million Bitcoin this year by June. So these are really dangerous numbers. I try to keep things grounded in reality because on this channel, I trade for a living. A lot of these guys that just do macro, they don't give you trade entries. They don't give you exits. They don't talk about where the individual asset can move to. They just, and this is including the bearish guys. They just say, well, the market's going to go down to the low 3,000s, right? Basically a JP Morgan call, Morgan Stanley call, Citibank. You guys know the whole litany of banks that are predicting that now. It's going to go down to low 3,000s. I'd sell anything between here and 4,200. That's that consensus call, right? So what I do is look at actual assets and try to help people profit based on what my trading is, right? But I want to share with you a video from Alessio Rastani, very popular YouTuber. And guys, I want to say this again, just right off the rip. He seems like a super nice guy. I don't have anything negative to say about him. I don't watch his videos. I was sent this video clip by one of you actually that follow him, and they wanted me to comment on it because he said something and I don't think he realized what he said. But I want to play the video clip, guys. We spent a lot of time the last couple weeks on this channel talking about market breadth, that indicator here at the bottom, how important it is to have a broad, widespread rally to confirm going into a bull market, and how you can use market breadth to understand how narrow the rally is, how you basically have 8 stocks holding up the whole market. This is a big week coming up, guys. We got the Fed coming out with their guidance and their rate hike, which again, 25 basis points is supposedly baked in, 80% chance. I believe that's Wednesday. Tomorrow they're meeting, but you don't really get any information out of the meeting. We had another bank failure, of course, First Republic over the weekend, guys, which is now the largest bank failure. It frog leaped the two previous bank failures of New York SIG and Silicon Valley Bank. It's the largest bank failure since 2008. So again, we've had another bank failure. The macro market indicators, as you guys know, are in decay. I played you the video from Darda last video, the video clip from Darda last video, talking about year-over-year claims being a leading indicator, and we're at 22% continuous claims, again with an average lead time of 2 months before the recession hits. We had our GDP get cut in half on expectations, was above 2%. Now it's 1.1. And again, the whole understanding of the bubble cycle. This is why I focus on cycles in my macro picture, because commodities move in cycles, equities move in cycles, housing market moves in cycles, and you can tie the cycle to breadth, which is why it's so key to understand. But let's go ahead and play this Rustani clip. Guys, just watch the clip first and then just see if you can spot what he's saying. It's a minute long, minute and 20 seconds long. See if you can spot what he's saying that is factually incorrect in the video. Okay, and then we'll talk about it on the other side. Lee, go ahead and play that clip.
But actually, there's something even more important than that. And that's shown to you by this data, courtesy of Jason Geppert of Sentiment Trader. According to Jason Geppert, who by the way is a fantastic analyst, he mentioned recently that the percentage of stocks in the S&P 500 with a rising 200 daily moving average has cycled from less than 5% to over 75%. In other words, the percentage of stocks out there within the S&P 500 that have a 200 daily moving average is sloping upwards, that has gone from less than 5% to over 75%. So there's a lot of stocks out there within the S&P 500 that have a 200 daily moving average is going up. And that's a good sign, it's a positive sign when this happens. In fact, according to Jason's data, as we can see here, whenever this has happened in the past, forward returns 12 months later for the stock markets is about 16%. It's about 15.9 or 16% again 12 months later. And this, by the way, has a very high win rate. In fact, according to Jason, this has never failed in the past whenever such a signal has occurred on the stock market. Now, of course, we're not saying it's a guarantee this is going to happen in the future. We're not saying it's a guarantee or a certainty that the market's going to go up by 16% within 12 months. Nevertheless, all we're saying is, according to data, whenever this particular signal has occurred in the past on the S&P 500, there has never been a loss on the S&P 12 months later. It does increase the likelihood or the probability that perhaps the S&P could very well rally and go up by 16%, likely by next year or by the end of 2023. I think this.
All right, guys, did you notice what is wrong in this video? Again, nothing negative to say about Alessio. Seems like a super, super nice guy. But he's using a data point from another analyst who's talking about tech, which is basically growth. How when it breaks out, it has a large amount of the stocks break out above their 200-day moving average, and it's at 75%, he says. But the problem is, do you see the chart that Alessio is referencing? It's the S&P tech sector. And Alessio says 2 or 3 times there in that clip, what? He's talking about the S&P, the broader market, is above its 200-day moving average. He's saying 75% is above its 200-day moving average. That's not true at all, guys. It's at 54.9% as of this morning. 54.9% of the S&P is above its 200, meaning basically half the stocks are not above their 200-day moving average. It's a very key data point. He's saying 74, 75%. He's also predicting a 16% upside move. Just to put that in perspective for you, he said 16%, which is why he remains bullish. 16% would bring you to a new all-time high in the S&P. So again, using the wrong chart, not understanding the metric to give you a premise, a data point of a bullish narrative in the marketplace, it's just another thing you have to watch. So again, what I have a problem with is not Alessio, it's not Alessio Rustani at all. But in general on YouTube, guys, this is why I focus on economists. I like to look at things I'm not aware of or want a deeper understanding of. a lot of the bulls, right? And I'm not saying he's a purple bull or anything. I don't watch his videos, so I don't have a deep knowledge of what he talks about. I'm just commenting on this one video. But a lot of the bulls pull a single data point to give you a bullish narrative. Well, look, 200 or 75% of the companies in the S&P are above their 50-day or the 200-day moving average. And that's factually incorrect. So what Alessio's trying to say, what that analyst was trying to say, which we're going to debunk here on my screen, what Alessio's trying to say is, look, when you have this much tech, right, or this much of the stock market above the 200-day moving average, which according to him is 75%, when you have that much of it, it shows you that 100% of the time you're going to have upside gains. And that's what he's talking about, making a new all-time high. The problem is, again, he's looking specifically at a tech chart and he's not understanding what the actual breadth of the market is because he's analyzing it incorrectly. But all bulls do this. They show one data point. They'll talk about the halving cycle or something like the hash rate when you're talking about Bitcoin. They show one data point. They don't paint the full picture for you on the canvas. We have the 40-year high yield curve inversion, 40-year high inflation. They never talk about the macro, 22% continuous claims year over year. 100%. All these indicators, by the way, are 100% for predicting a recession. Now, if you understand there's a recession coming, mild, run-of-the-mill, deep, doesn't matter. If you understand there's a recession coming, there's some data points that are very key to understand how to trade this market. How many times has the market bottomed ahead of a recession over the last 75 years? Zero times. So if you know the market never bottoms ahead of a recession and every single big bank now is talking about a pull down and they're all talking about some type of slowdown, recession, all of the indicators, the leading economic indicators that have been 100% accurate, again, looking at all of the litany of indicators, they've all been 100% accurate. You're getting a recession, base case, you're getting a recession. The market will trade at a lower multiple when you have that recession 100% of the time, and the market has never bottomed prior to a recession. The market has never bottomed while the Fed is actively raising rates. They're raising rates again this week, guys. The bottom was put in October. So regardless of where price gets to, this is why we always talk about upside risk as a trader. You have to understand your upside risk if you're shorting, and of course your downside risk if you're longing, okay? This is why we look at these metrics, but you have to understand the macro market environment to really understand how to trade in these marketplaces. Doesn't mean you're going to be 100% accurate. Everybody that's a trader that watches knows you're going to lose trades. You're going to win trades, you're going to lose trades. But let's go ahead and jump into the analysis of what basically Alessio was saying. I'm going to show you the actual way to look at this with market breadth, okay? So market breadth, what is that? Again, you're looking at a metric of the S&P 500. And we're going to use the total S&P 500, not just the tech sector. So the total S&P 500. Key point here to understand, guys, when you have something such as the pandemic, okay? Do you see your market breadth? You fall all the way down. I can't see with my picture in a way, but I believe that's below 20% there on that. Yeah, actually low single digits, okay? That's where you fell on market breadth, meaning the number of stocks above their 200-day moving average. And what you can see happens here as you recover, look at your market breadth. More and more stocks start getting above the 200-day. As cycles mature, and especially in bubble cycles, there's a unique phenomenon that happens in bubble cycles. That happened in 29, it happened in 72, it happened in .com, okay? It's a unique phenomenon in equity bubble cycles. The high-flying stocks that gain the most gains will peel off as the broader market still goes up. And this is what you had here. Look at your market breadth topped out here around 91, 92%. Let's just mark this really quick. This is kind of we're getting to the TA, I promise, okay? We're going to do the TA, but this is important, okay? This is a teaching opportunity. A little adage I would like to say. I've noticed a lot of people with the biggest channels, I think they tell people what they want to hear. And then people that have these confrontational channels are actually the true professors, because we're giving you information that a lot of people are either offended by because of their market view or their narrative of how they view the world. They're either offended by, or to a lesser extent, you're challenged by it, right? And that's why I think this channel has been a success in its own right, getting up to almost 30,000 subs, which, by the way, click the like and subscribe button. Market breadth, guys, tops out roughly 92%. And what does price do? Okay, look at what price does. Price keeps going up for the index. Where's your actual peak here on your market breadth? Over here. So April 21. Now, price ran all the way up to January 4th, 2022. But look what the actual stocks started doing. They started to decline below their 200. This is exactly the same phenomenon you had in .com 72, 1929. Okay. And so then the market starts to decline. It catches up. Again, leading indicator here of what's to come. You're losing the vast basket of stocks above the 200. And as they keep declining, the market starts following. And then you have a rally off of a base, off of a number. Now, the problem that the market has at this juncture, right? Let's go ahead and look at this. The problem that the market has, and this is on the daily time frame, guys. This is as the S&P is trading at 4182. Right now, you're at just under 55%, 54.9% for your market breadth. So again, half the stocks are below the 200, a narrow rally, these are the mega cap stocks holding up the market. This is going to affect cryptos. It's going to affect everything else. So you need the rally to broaden out to really get more momentum. And you can see this here. Look at here. When we made this last double top structure on our last pivot date, right? Look where you were at over here on your breadth. You're at 75%, which is where Alessio thinks we are at now, and we are not. We're 20% below that. You were at 75% on the S&P. So you're 20% below that, but you're at a co-equal high, narrow market rally. And what did this do? We traded this. I gave you the trade for this. The S&P fell 9%. Okay, it took days and days of printing candles, but eventually capitulated and fell 9%. You see it in your market breadth, okay? And it's the same thing up here. All these rallies, you start looking at divergences, right? Look at this peak here. This is up at like 4,600. Look at this peak. You have your market breadth come up, hit this peak here at just roughly 55, 59% off of a low, off of a rebound, and then it fell to a deeper low. And this is exactly what the market did. So understanding market breadth and the fact that you're have a narrow market breadth, you're rolling over here, making a double top basically on your market breadth. And guys, we have a market breadth indicator that we're working on exclusively for market makers. All of our indicators, money flow, market breadth, VROC. These are all free indicators when you do check out our room, guys. Our Discord is available for you to join. If you download SimpleFX or BingX, either one of them will pay for you on your first month of membership to join our room. Highly suggest you do that. If you want to be in a cool community, a fun community, talk to other traders. We have over 30 countries represented in the room, and you get in for free. You get all of our indicators for free, and you get to keep them for life. We don't sell you indicator packages. There's not multiple levels of membership. None of that garbage, guys. Want to make a cool community of people that want to learn to trade, or if they're already a successful trader, be in a community of traders. And of course, we have trade signals, TA, all the expectations that you would have joining a trading room. Everything's there. Block state updates, all of that stuff, and multiple market views. Not everybody views the market the way I do, guys. But do check out those sponsors. SimpleFX. You can get up to $5,000 instantly in your account based on your deposits. Decentralized forex exchange to trade everything we talk about on the channel. And of course, BingX is your traditional crypto exchange if that's what you prefer. All the links, all the information, download the app, message Lee in the Telegram. It's pinned in the YouTube comments. It will be when I publish the video, as well as the video description. Okay, so let's go ahead and move on from here. So this is where you're at on your breadth. Your breadth is lower than your previous box. Your price is going higher. Your breadth is actually starting to flatten out. Now, if we look at this on a weekly perspective, there's another way you can do this, okay? On a weekly perspective, looking at this with the 3-day on a 50 simple moving average, just to give you another comparison. So when you look at this, look at your peak here, again, up at 92%. We're above the 50 on the 3-day chart before you had your decline. Price still failed here. You can see it in the money flow. You can see your volume getting lower and lower and lower as you come up to a peak. Your volume now on this rally up is roughly 50% of what it was on the last rally up to 4,300. Remember, 4,300 is your upside risk target, but your volume now is half of that. And again, your overall from your last double top structure, your overall what's it called? Your overall breadth of the market, man, talking too much. Your overall breadth of the market is 20% lower than the last time. So again, this to me is a rally to fade. So our upside risk is still going to be the same, but you can see this over and over again in these rallies that fail. And we rebounded off of our low. And this is back here in March of 23, as you can see this on the breadth and going all the way back. Yeah, March 9th, 23 in a 3-day chart. And you're roughly hitting that 60% area, as you can see. And to me, it looks like it's going to print a double top, regardless of what happens. I think Powell's going to talk down the market here. We're in the same range that's provided all of these trades that we've talked about many, many times already. All these different times we got in shorts in this market. And I'm in one here as well, which obviously is slightly negative at the moment due to today's price action. I think Powell's going to talk down the market. I don't think he wants it to rally. I think he's having a difficult time. We're in that final mile, right? The crucial mile of trying to lower inflation to the Fed's target rate. And so I think he's going to come out pretty hawkish with his statement. I'd be surprised if he comes out dovish, but Powell always tends to surprise. But this is exactly what I'm looking at, guys, is the breadth, the money flow, which is, again, we're looking at the percentage of stocks above the 200. How narrow is the rally? Most of those stocks had big pops already. And I think this is going to turn around, and I think it's going to fail, and we'll be coming down to our target 31.41. I do think the recession is right around the corner, basically at your doorstep, okay? And I'm seeing this in the indicators and, of course, the economic indicators as well. And again, let's go ahead and look at this on our pivots. So our pivots, again, we had our pivot last time back on February 14th. That's where we got the 9% decline, hit our pivot, price dropped $120, and now we have this reflexive rally. However, when I zoom in on this, I mean, to me, the price action, different dollar amounts here, but the price action looks the exact same. So you had this rollover here, right? So you make your top here, you come down to this deep decline, and then you bounce back up, and then you come back down. That's how you make your double top. And here it looks to me, as of right now, you're still doing the same basic movement here, okay? Down, and now this is our up, and then this will be your down again. And we're still in that range of the 41.43 to 41.80. Again, that upside risk, guys, it's 42.89 is the upside risk that I have if we do break out. How could we break out? I mean, if Powell pauses, which is not priced in the market's going to rally. If Powell does a dovish hike, says we're raising 25 basis points, and he does not say, and we're going to see what the data says to determine future rate hikes. If he doesn't say that and just says we're raising 25 basis points and we're pausing, then you could see the market rally. But again, that's the upside risk, which we've been talking about once again for weeks. But I'm in this for the long game. I'm building a position. If it goes up, I'm building a position. No matter where this market goes, I'm fading it responsibly, managing my risk. And that's the key thing that everybody needs to do. But I'm expecting this to turn around and complete our massive double top. If we come up to 4,200, whatever, I'm still expecting the exact same move. The price targets haven't changed. 31.41 on the S&P on the next pull down, looking for mid-June. Why hasn't it changed even though price has gone up? Because again, historical market trends of the S&P always trading at least 33% down from its cycle high puts you there, which is why all the big banks have the exact same target as me now. The difference is, of course, I gave you that target. I have that target as of last summer, okay? Understanding how the market moves with Fibonacci and market cycles. So let's look at the VIX. The VIX continues to drop, which is why you're getting a little tiny rally today. 15 spot 59. Guys, this is such a danger zone for the VIX for complacency. Again, going all the way back 25 years to the .com, you're at that bear market top, and the VIX is continuing to show. And this is another thing the bulls do, and this is a valid bullish argument. The problem is, if low VIX, price can go up because it's complacency. So you have a natural drift, natural rise in price. The problem is, again, the macro market indicators tell you there's a big underlying problem in the economy, and the big money in the market knows that. That's why you have record shorts on the S&P. They know that. They're waiting for this market to dump, and they're going to fade, I believe, the rally, whether it's here at 41.80 or 100 points higher at 42.89. Okay, they're going to fade this, and you're going to see this bounce up. Let's look at Bitcoin. Bitcoin, again, the riskiest of risk. Is it giving us a barometer here? Is it a barometer of risk giving us an advanced reading of what's to be expected? Looking at the weekly, my target's still the same, guys. Going to ask that a lot. 12,888 to low 13s. Looking for that by mid-June, okay? And now it's on a weekly. Looks like to me you're building a distribution box. If we go to the daily time frame, you can see, again, this looks like a double top. We almost came up to our 786 retracement here. Let's get that where it needs to be. 786. We did hit it here at the 29,660 off that impulsive move down. And now we're rolling back over again. Let's get a downward projection on this as well. I'm going to use my impulsive move down to our peak, up to our high. So what Bitcoin needs to hold is 27,305, essentially your neckline here in this double top. Okay, you see this double top? It's essentially your neckline. And if you do lose your neckline, then you need to watch 26,565 and the 1272 at 25,624. And of course, your 1618, which will be struck, is 24,428. Okay, so you'd be looking at this shape in case you're curious. Breaking your neckline, coming down to the golden ratio, 24,428. And again, you could have retracements, waves up at any of these levels. And this is if and when the S&P rolls over, which I believe it will. It's a matter of time, and a matter if it wants to roll up another 100 points or not before it completely capitulates. You have your 200 sloping upwards. Again, this is traditionally bullish. Your bullish technicals are there on these assets, okay? Your bullish technicals are there. Your macro technicals, if you will, your macro indicators are extremely bearish. So this is why you have a bull trap that's formed here in the marketplace. And you need to understand, again, my market view, feel free to disagree, but my market view, and this is the difference of buying Bitcoin in the 50s, holding it up to 69, and then listening to people tell you it's a correction. Bitcoin always goes back down to 50. Bitcoin always goes back down to 40. Bitcoin's always going to go back down to this level here in the 30s. It will never lose 28K in my lifetime. And then it drops and goes all the way down to 15.5, and you're still holding what you bought at 50K. Okay, there's a lot of people that are in that situation. You have to understand the macro view. Limited upside potential, much more risk to the downside. That's the key takeaway here. Let's look at our indicators. Money flow is crossing into bearish territory. Your overall buying volume is switching to bearish as well. Let's look at the NASDAQ, guys. The NASDAQ market breadth, this is a NASDAQ 100. This is at about 68.8. So this is almost 69% right now. And on the NASDAQ, again, because tech led the rally. Remember, tech was the redheaded stepchild. No offense to any gingers out there. I'm half Irish myself. But tech led the rally. It wasn't supposed to do well because the pros, the market, the money managers that are supposed to be managing your money all said the growth was going to do horrible, and they were all in the wrong stocks for this rally coming back into the beginning of 2023, okay? So then they all chased the mega cap stocks, pumping up tech. And if you look at this, we're at 13.2. Remember the last few videos, been telling you, I still have the arrows here. Watching 13.2 to 13.4. This is the area that I like, up here at 13.4 and down here at 13.2. And you may end up ping-ponging in between these, making what you have here in a Wyckoff structure, making a double top and returning back down. If the S&P does want to move up another 100 points from here, okay, I'm not saying it will. If it does, your upside risk target, you could easily come to that 13.4 target and get some wicks above it as well before you start making a bearish structure or before you start capitulating. Because what you have here, looking at this, we can just throw this so you can visualize this, okay? You have your Wyckoff structure. Buying climax, and there's your reaction. And what are you trying to do right now? You're trying to base on top of your daily time frame on your NASDAQ. You're trying to build your Livermore pivot. Your Livermore pivot means you come up, you hold your base, and you pivot out to the upside. That's where that 1618 at 13.4 would come into play. You had a nice spring off the Wyckoff down thrust here and came back up. So that's what you're trying to do in that situation. Again, Powell comes out hawkish. You may just have this situation when you just start rolling down. You don't have to build a bearish structure. But that's what I'm looking at here on the NASDAQ. And again, if you just want to look at some impulsive targets to the downside, you could simply throw up a fib retracement and look at some key levels of where you're going to get to. Your 200's roughly at 12,000. That's what you want to see if this thing holds. If your 200 holds, you get a nice bounce off of it, then that's all you're getting is that drag down. I don't think that's going to be the case. I think you're going to knife through it like a knife through hot butter and keep falling. But watch that 12,000 key inflection point of losing the 200. This is definitely when you'll see a lot of the algos switch to selling hardcore, propelling the price further down. And then your key area, I mean, this is what I love about fibs. You know, people draw these boxes. I say this all the time. People draw, look, this area right here with the candle clusters, and this is a good support zone. All you needed was a properly drawn fib, and you get 10,711, which lines you up with that area. So that's your key structure here. Again, these are your lows, your October lows. I mean, imagine that. These are your October lows. This is what you need to hold. And a lot of these inflection points are going to give you nice rallies. But we're still at that stage where we have to get the market finding its home, where it wants to go. Does it want to? Does the NASDAQ want to go up another 200 points before it falls down, or is this what you're seeing here, building the bearish structure and then starting to fall down? So I still like the NASDAQ between 13.2 and 13.4 for a potential trading opportunity. But guys, all of these trades right now, obviously with the Fed meeting tomorrow and announcing the rate hike as well this week, I would wait and see what happens with the Fed, because this target now of 13.2 could easily become 13.4 if Powell says anything dovish or is perceived as dovish, and it will definitely become 13.4 if he pauses, okay? But to each his own. I'm just telling you what I would do in these marketplaces. The DAX, again, following the S&P as well, bouncing up 15,993. Our upside risk target is 16.2 still. So 16.2 still where I like this, and you still have this double top structure. The DAX is following the S&P, and if the S&P is being bullish here, waiting on Powell, you're going to see the DAX be bullish here as well. Money flow, you were overbought. You got a little wave down. Nothing too spectacular. I mean, it's up spot 42%. These aren't big moves right here. It's just a nice demand wick on this candle here on the daily, though. But the Rangers are still holding true for me. I still like the DAX for a setup to trade as a short, with my upside risk being the actual number here, 16,281 would be the upside risk. But I don't think that market's going to get there. Looking at the CAC, this fell beautiful. The French 40, guys. This fell beautiful, and you're just printing a classic double top here. You got rejected up at your 618, 75.32, as you can see. Came back down to a nice tail down here at about 7,400, and you're trying to roll back up. If there is more upside, the CAC made a new all-time high. I mean, your co-equal double top would be basically 75.95. You could easily come down a level below that, again, 75.59, which is where I really like that setup. If you get a little bounce in the S&P, watch for the CAC to come to 75.59. Looking at the Australian index, the ASX, Mike. All right, so looking at the Australian index, I reckon this is going to do something. So let's look at this. So we have the 3-day chart here. The 786 is still at 73.86. I told you this is going to be strong resistance for you. And guys, just from a basic TA perspective, and what is this shape here? You have a head and shoulders that you printed. You see this? So you want to watch this 786. You also have a double top structure that you've made here as well. You want to watch this 786 key retracement for making double top structures. And that's 73.86, and you're just printing, bouncing back and forth. I'd wait and see what the American indexes do, right? The Yanks, see what they do and see if this thing starts to roll down with the American indices. But you can see here at 73.86 is strong resistance. Your upside risk would basically be this impulsive move area up here, 75.38, where you got to before, and you're trying to base here. You're just below the top of Wyckoff, but maybe you can pivot out and get up to that level, and then you'd be printing a really clean double top here, but your structure base would be down here, right? So like that. You're printing a larger, cleaner double top there. So that's what I do on the ASX. Let's look at Ethereum real quick. Again, with Bitcoin going down, Ethereum's going down. Your key levels to watch here, 1795 for Ethereum, where you found support previously here. You lose that, watch 1700. And of course, watch your 1618 at 1424. If Powell comes out, which I believe he will, as with a hawkish tone and signals there may be future rate hikes ahead, I think you're going to see all the markets pull down. Man, this video is getting long. Let's keep going. So Tesla is still a great trade even if you're holding it, guys, because we got in at 208, went all the way down to 150. What is that? 151, 152, and you're below the fib here at 159.49. So fantastic trade. Just trading doesn't have to be difficult. Doesn't have to be difficult, guys. You can just print double tops. You can print double tops, and if you understand the macro direction of the market, you can make good trades. If you don't understand and you think we're going on to a new all-time high, then you would not have made this excellent return. So watch Tesla here. Your key support level is going to be 146 and then 126, 101. Looking for Tesla to come down and this next wave down again. Just basically looking for it to get chopped in half on this next wave down, which would put you somewhere around, like I said, $75, $80. Looking for that 1272 somewhere hit between there and the 101 at the 1 fib. So between 70 and $100 would be a nice landing spot for the next pull down. NVIDIA is at 285, breaking out of our predefined trading range. I've been in and out of this trade twice myself, trading these waves, and now we're bouncing up. Well, what would you guys suggest that I would do here? I'm thinking if I'm going to look at NVIDIA, I want to see if 288, the 1618 holds, FI. If this holds for some type of top and you start getting resistance here, this is where I'd be looking to get back into NVIDIA around that 288 marker. But again, wait and see what Powell does, because that's going to determine the trend for the marketplace. Or if you're a risk taker, that's all on you. It's all on you how quickly anybody wants to enter a trade. Do your own research at all times. MicroStrategy, Michael Laser Eyes Sailor. I wish I could get the engagement he gets on his video, on his tweets, just by tweeting a stupid picture of Bitcoin with laser eyes or something, or himself with laser eyes. He gets, tens of thousands of interactions. But so you can see this double top structure forming here. Again, we shorted this above 333. 3 opportunities so far to be in that trade. And this is printing a clean double top, guys, and this is going to roll. Okay, this is going to roll down, and then you have your targets. We've been over many times. Watch 180. Once you break 228, watch 180. And then you're looking at 102 as a target when BTC pulls down as well. I'm looking at a 102 target on MicroStrategies. First Solar, look at this. So beautiful. I pumped up this trade for a while on our Discord, and it took a while to break. That's the thing, guys. Trading can take time, especially when you trade on larger time frames like I do. But, been watching this for a long time, shorting up here at 217, and look at the drop. I knew it was coming. This is a garbage company based on ESG investing. Not saying they don't do good work, but they don't make any money. And the stock went up, over 150% since last summer. I think 80% this year so far, or 70% this year. It's crazy. It's way overvalued. I've showed the metrics on it before, but this is how you get nice returns. Hitting below 171, shorting above 217, and now where's price? 180. I mean, I wouldn't do anything with it at this point, guys. Most people probably took profits. You can consider seeing if this is just holding up here and see if it will roll down further with the broader market, which I believe it will. But if the market rallies a little bit more, you could see some more upside. It's the joys of trading, but what a successful, beautiful trade. Gold's not doing much, guys. You're getting a lot of doji candles here. It can be a continuation of trend, reversal of trend, macro picture. You guys know the drill here. I'm not going to beat you over the head with it. 2055 is a target that I like to find these big trades if gold's going to complete the GFC cycle and retrace, have a nice 20, 25 to 32% move. And that would be that target. There's key levels to watch on gold. If it gets up here and falls with the broader market, you need to watch your base at 1626, and then you're looking at 1521 and 1389. Of interesting note, the junior miners, they're only about 35% of their high of where they were in the pandemic. So to me, that divergence of the value of the miners versus where the actual assets trading, I'm taking that as a bearish confluence considering what we did in GFC, which is fall 34%. Okay. Because I think that's the cycle. Again, I made a gold and silver video months ago, guys. I think back in January, predicting we'd have this exact same cycle repeat. So sticking to my guns on there. I'd like to see this come up, and I'll put a tasty trade on here if I can. If the money flow comes up, and gets overbought, giving us our clear signals that we've had of every time above 2055. I'll be looking at that to see if that rolls over, because that could be a nice little treat. Looking at silver as well. Silver 25 spot 47 is where we got to. And this to me, just on the 3-day chart, you could look at this on a daily, but it just looks like you're setting up for a double top. But my target here on silver would be 26 spot 99. And you didn't get to the overbought level that I want to see, that massive euphoric level. Look at your ratio of buying volume. Boom, right out the top, right, matching your euphoric. What is that, a 95 reading on the MFI? It's like massively overbought. So we didn't get there. We may not get there, and you may just fall and it didn't take the trade and be like, oh, you didn't short it. Are you upset? No, I mean, it's silver and gold. I actually, I own both of these. I don't want them to fall necessarily unless I want to accumulate them at a lower level. So no, I just view trades as trades, guys. Don't get emotionally attached to anything. Long video. Hope you enjoyed it. And next video will be Thursday, guys. We'll go over what the Fed did and what the market's doing at that time. Hope everybody has a fantastic next couple of days. Talk to everybody soon.